So, how do we play this market rebound? Well, I think it does make sense to invest in more cyclical stocks. And I'm saying that I know that some of you guys have been around markets a long time and you know what cyclical means. Some of you, let's just dive into what that means. A cyclical stock simply means that these are stocks that benefit from a recovery in the economy. So there are certain areas of the market that do well when the economy is growing, and they do poorly when the economy is shrinking. So we want to be invested, or at least put some of our investments into some of these stocks that just do very well when the market is expanding. The other thing to think about is we also want to look we there's some big questions right now as to whether the economy really is expanding or not. And I don't have my crystal ball. J Rod knocked it off my desk the other day and it shattered. So I can't tell
You're
you
not
exactly.
sorry.
I can't tell you exactly what's going to happen with the economy this year. There's a lot of issues, with employment, with inflation, with the Fed tightening rates, with international affairs, China, Ukraine, and so forth. There are just a lot of question marks out there. So we don't really know whether the economy is going to expand or whether we're going to have a recession this year. But we also don't have to know that right now. What we want to look at is what are other investors expecting to happen? Because if investors are expecting a strong economy this year, they're going to be buying the cyclical stocks. And so we want to be in those stocks so we can make money. And then if things change, then we can adjust and adapt. And that's what investing really is all about, making sure that we're adapting to what's the expectations are on the ground and having an eye ahead to say what could change over the next few months. So today we're going to spend a good bit of time on some cyclical areas of the stock market that I think you can invest in safely. And we'll also avoid the cyclical areas that I think are too speculative, that I think are too aggressive, and that have a lot of risk. So what this means is we're going to be putting more of our capital into cyclical stocks. What it doesn't mean is that we're going to jump into the most popular, most risky stocks. Now, many of these stocks are up 80 to 100% over just the past few weeks. I mean, it really has been astounding to see how some of these speculative stocks have rallied. The thing you got to realize is that nothing has necessarily changed with these companies. And so, is the company really worth 80% more than it was worth at the beginning of the year? Is the company really worth 100% more than it was at the beginning of this year? The answer is probably no. And so, if that's true, then we want to be very careful about not putting money into these areas. Now, think about this in terms of risk and return. Yes, there are investors that have made a lot of money in a short time with these speculative and I think very dangerous stocks. But these are the kind of stocks that you can wake up one morning and they're down 20% overnight. Or if something changes in the Fed, a Fed speaker steps up to the podium and says something that people don't expect, they could be down 50% over a week's time, or even more if the GDP report comes in weak, or if China starts moving troops towards Taiwan, or any number of other things. So yes, there are some opportunities that we have missed this year, but I'm okay with missing opportunities that carry so much risk that they could really hurt you with a moment's notice. So we want to avoid those kind of situations. Um, Typically, when I look at how I invest my own family's money, I use a barbell approach. We've talked about this a little bit before, but a barbell approach where you have two different sides of how you're investing. One side is very steady, very safe, very conservative. These are companies that generate profits year in, year out. These are companies that pay you dividends, so you get cash flow from these companies. And these are companies with stable businesses, so you can sleep at night knowing that they're going to be okay. Procter and Gamble, Chevron, Texaco, um, many of the health. There's some healthcare stocks in there, even retail stocks. But these are good, solid companies that are going to be around for a long time. And then on the other side of the barbell, we have more aggressive plays, and you want to have less capital in this side. How much capital you put into either side depends on you and your risk tolerance and how safe you want to be and how comfortable you are taking risk. But you want to have, I still think, most of your capital on the safe side, and then a certain amount, depending on your risk tolerance, in more aggressive plays. And that's what we're going to be talking about today. We've said many times that income plus growth equals boom. If you can set up a portfolio of stocks that give you income, that's great. If you can add some extra growth on the side, that's even better. And you put those two categories together and you wind up with wealth that's growing and wealth that's actually exceeding inflation, wealth that's helping you do the things that you want to do with your family and create wealth for generations to come. So that's really what we're after here. And that barbell approach can help you with that. It can really add to your performance by adding some aggressive stocks here and there where they make sense with a small portion of your capital. So that way, if they don't work out, you're not hurting yourself, but you are giving yourself plenty of room to make money when these speculative or more aggressive plays play out. The bottom line is that cyclical stocks right now are good. They're doing very well. And while we still want to be invested in the secular stocks that make money all year round, that make money in good times and bad, we want to have some of our money allocated towards cyclical growing stocks that benefit from either a growing economy or at the very least from expectations of a growing economy. That's what we're focused on for this month. We'll be circling back next month to talk about what new opportunities are popping up, and we can revisit some of these stocks too and figure out what's working well, what's not, how we need to adapt. Because remember, adapting is how you preserve and grow your wealth